potentially.
Do you see that process, President Lagarde working in reverse? So actually, I know it's different because of the proximity to Russia.
What we're seeing at the moment is more this swing or substitution that was described earlier in the day, where, because of COVID, everybody suddenly decided to stop using any kind of services, particularly if there was social distancing about it, and move to goods. Hence the car industry in the US and, stationary bicycle rather than the fitness club. And now we are seeing this sort of substitution back to services where people who've been deprived of restaurants, hotels, transportation, theaters, and all the rest of it, that side of it is currently booming and is sustaining the recovery that is otherwise under the various series of shock that Andrew was alluding to. So how these things are going to evolve in view of the uncertainty that we have in front of us here in Europe is something that really remains to be seen.
But how difficult, President Lagarde, is it to, for example, model a gas embargo from Russia?
It has proven. Look, it has proven extremely difficult, and as we have seen from the sort of misunderstanding or wrong assessment that we have seen in the last couple of years, that is difficult for sure. And the rest is, for the moment, more in the scenario planning world than in the remodeling of what's going to happen on gas prices.
Mr. Carstens, talk to me about emerging markets a little bit. So first, it's I don't know whether they're coming to their stride because they're used to the volatility, but there are huge implications, of course, of what the dollar is doing.
Yes, of course. I think at the end of the day, a very strong dollar implies for many of them very tight global financial conditions. And so far, again, as I mentioned, the exchange rate, the impact or pressure has been contained, but at the cost of very high rates. What is a little bit concerning, not that it couldn't be managed, but for some emerging markets, this is arriving at a time where there is high corporate debt and high sovereign debt. And therefore, some fiscal prudence is important at the time where emerging markets are facing still very severe challenges. Many of them haven't made as much progress with, for example, vaccination than in other countries. Also, for many of them, the impact of the increase in commodity prices, particularly in food and in energy, is very important. Usually commodities per se, foodstuffs and energy occupies a much larger proportion in their basket than in advanced economies. So that obviously reflects itself in more social need. And well, of course, many governments, according to their capacities, they are doing programs to assist people. So at the end of the day, they are on a tight situation. They have to manage things very prudently. I think if we compare this with other periods, emerging markets are better prepared. But I think that the challenges are there. I think a big challenge for many emerging markets, including I would say China, is how to get growth back at a much healthier pace. I think the growth in emerging markets has slowed down, not now, but even before the pandemic. To some extent, the virtues of globalization have sort of run out of steam, and therefore the relevance of structural reforms are very important. We need to look much better into how to get growth going independently of the use from fiscal and monetary policy. And to a large extent, that also applies to advanced economies.
Thank you. Governor Bailey, do you think inflation in the UK will be more elevated for longer than in other parts of the world?
Well, as Christine has said, we are going to be affected by the shock that Christine described in terms of energy prices in Europe, because essentially it's a common it's a common shock in geographical Europe. I use that term carefully, because it's a single, particularly for gas, it's a single supply system. So although we don't actually import a large amount of gas from Russia, it doesn't, in a sense, the price is formed outside that particular. So in that sense, it was similar. I think where I would, as things stand, expect some more persistence in the headline rate is because we do have, as I mentioned earlier, this price capping system in domestic energy prices. At the moment, it's a 6-month cap, but there is a proposal to take it down to 3 months. But other things equal, you would imagine that that would put a bit more persistence in. And we will, of course, have to explain that, because if we can observe a downward path of underlying inflation, we will have to be very careful to explain that if that's how it emerges.
But does Brexit actually make bringing down inflation harder?
Well, Brexit, I should say, it's very hard at the moment, if not impossible, to separate out the immediate effects of Brexit and the immediate effects of COVID. So when I look at trade and when I look at labour market particularly, you can see effects taking place, but you can see that COVID and Brexit are having similar effects. And the reason I say that is because the Bank of England for some time now has had sort of a path of a Brexit effect in its projections, which said there would be a fall in trade intensity initially, and over a much longer period of time there would be an adjustment to that. And we haven't yet seen anything to vary that assumption.
Does the fall in sterling actually help with the economy?
Well, we don't target the exchange rate, let's be clear. The exchange rate is one of many inputs to many influences on inflation, and that's the way I treat it.
So has it been a positive? I mean, we used to say that it was a positive if it was lower.
No, I don't sort of attribute positives and negatives. I'm not surprised, by the way, the path of sterling for the reason that, as I said earlier, I think the UK economy is probably weakening rather earlier and somewhat more than others. I think that's been somewhat evident now for a few months, and of course it is over the last few months it's happened. But I think I do. In our system today, we do not attribute good and bad to movements in the exchange rate. It's one of the many things that goes into the analysis process in terms of how we think about the evolution of inflation.
I was going to ask you about the dollar and whether that helps with price stability, dollar strength.
So, like Andrew, we don't have responsibility for the level of the dollar. That's the elected government's job. That's the Treasury Department's job. And so it's just another financial condition to us. And since our economy, the external sector in our economy is so much smaller than it is for the others here, it's not that important. But dollar has been strong, which would tend to be disinflationary, but only at the very margin.
I mean, I think what we're seeing these days are adjustments in exchange rates. But I think the way of thinking of those adjustments in most economies, including in emerging market economies, are part of the adjustment process. I mean, they are endogenous variables. For example, the dollar is stronger because the US economy is stronger, because interest rates are higher, and also how the shocks that are around are affecting the different economies. So the fact that you have a very strong commodity price in Europe with gas and so on and so forth is very logical to think that the real exchange rate will depreciate. And that's part of the adjustment, So I think we're in a world where in most of the cases, exchange rates are part of the adjustment. In some cases, in particularly in emerging markets, it has more of an impact in the monetary policy management, is because the pass-through for moving of the exchange rate into prices is much higher than in advanced economies. So in advanced economies, it doesn't, unless there are huge swings, the impact on the trajectory of inflation is not that relevant.
Chair Powell, Mr. Carson was talking about a gray box. What's your gray box? Is there something that you wish you knew that would help in setting monetary policy? Only one thing.
Yeah, no, I'd go back to the same thing really, which is what did we get wrong? And that really was looking at these supply side issues and believing that they would be resolved relatively quickly. And that, by that I mean there were going to be vaccinations, everyone would get vaccinated, so the millions of people who dropped out of the labor force would come right back in, so wages wouldn't be under such pressure. That didn't happen for a range of reasons. It didn't happen. In addition, the bottlenecks and the shortages haven't been alleviated yet. And then on the back of that comes the new shock in the form of the war. But it wasn't something wrong with our models, because it wasn't in the models at all. It was a question of how to assess the persistence of these supply side shocks. And I do think that there'll be, to Augustine's point, and there is a lot of work going on to get smarter about the supply side. In the nature of it, though, it was a deep in the tail kind of a risk, and those are very hard to predict and assess when they come.
Yeah. Because monetary policy is not an exact science, how often do you actually speak on the phone to exchange ideas? Do you call each other and say, like, well, I've done it this way?
I can help out. I mean, because part of my job is to be able to attract them to Basel 2 times every 2 months, to have very, very deep and open exchange of views.
We do talk, but we're not going to tell you.
And you all show up.
Yeah, you'll show up. We speak quite often.
Quite a lot, but you're not going to tell. President Lagarde, the ECB decided to apply flexibility to reinvestments from Friday, July the 1st. What will be the guideposts?
We decided. Look, I think, if you allow, I'd like to just come back to why that is. Yeah. Because I think that this risk of fragmentation that is much talked about is something that is very inherent to the European construction. Yeah. And to the fact that we have 19, soon 20, but let's say 19 for the moment, member states that each have their respective fiscal policy, that each have their respective financial markets. And as a result of that, our unique monetary policy has to be transmitted throughout this imperfect market of ours, which has no fiscal union, no monetary union, no capital markets union. And as a result of that, we just have to make sure that our monetary policy stance is actually transmitted throughout the entire euro area. And the two of them, I think I used that word, I don't know if it exists in English, but they are consubstantial. For our stance to be effective, it has to be transmitted throughout, okay? So to do that, if we see that there are unwarranted disruption to that transmission, and if our stance is impaired as a result, we need to take action. And that is the reason we decided that we would use, as of, you're right, Friday, that's what I said yesterday, we would use the flexibility in the reinvestment of our pandemic emergency purchase program redemptions in order to address the potential risk of fragmentation. Second, we also decided, and it's work in progress, so I'm not going to comment upon it. I know that some would like to have details and understand before everybody else, and particularly before the Governing Council, what the details of that instrument will be, but we decided to reinforce our capacity to properly transmit our monetary policy by devising a new tool that will be considered by the Governing Council of the ECB on July the 21st. So don't waste your time asking me for details, criteria, conditions, safeguards. All I said is that it has to be effective, it has to be proportional, it has to include the right level of safeguards. And that's all I will say at this point.
Okay. How do you direct staff?
And it will be effective, and it will be proportional, and it will have safeguards, and it will be there, believe me.
So how do you direct staff? I'm going to try my luck one more time. How do you direct staff when they design this new tool?
I said what I had to say.
The lady is
Thank
not
you.
for turning, is the famous way. How do you look at China, Mr. Carstens? How should we look at China at the moment?
Well, I mean, it is of the essence that things start improving more quickly in China. I mean, certainly we need the growth that has come from China. Mm-hmm. They play a very important role in the supply chains. I mean, many of the tensions we're seeing around the world could be mitigated by having higher growth rates around the world. I mean, part of the way we have started this conversation was trying to assess, or you wanting to hear our thoughts about how can we bring down inflation without affecting growth. If we have other sources of growth, that would make the whole adjustment process simpler. Now, what is one major engine of growth that has not been contributing as much as it could? I have to say China. No, they have problems that are well known. One that I hope that can be resolved soon is the one in the housing market. I mean, the housing market has been, or that sector, it's a very important contributor to growth. A lot of, certainly very much impact in the rest of the global economy, and it's a sector where the Chinese authorities have been working a lot, trying to bring it back to its foot, and hopefully they're close. But I mean, I would say at this stage, for their own sake, they're not growing as much as they certainly would like, and certainly they're not growing at the pace I would like them to see growth, because I think it would help us a lot in trying to solve some of the tensions we're living today.
Do you think we'll see, Chair Powell, more deglobalization, and how that will impact our economies going forward?
So there's certainly a threat of that, and this is not the work of the central banks, but I do think it would be a plus if we were to find a way to for China to take part diplomatically and economically according to a common set of rules, and that would be a big plus for global growth if we could get back on a path to that. But it's obviously that's the work of elected governments, not for us. In terms of globalization, yes, I mean you can imagine a world. It's not hard to imagine a world where we break into these blocks again, and that would be a world of lower productivity and lower incomes over time. It doesn't have to happen that way. People are looking at shorter and more durable supply chains. It's not clear how much of that will happen, and if so, what would be the effects? That could be more secure, but perhaps not as efficient as the long but fragile supply chains that we've had. So I think it's a very important question, and there's certainly a risk that the benefits of globalization would be lost, but obviously there were benefits and there were costs to the advanced economy, certainly.
I mean, a question for all of you, and Chair Powell, I'll start with you. What have we learned about the last 10 years of monetary policy, some of the tools that were used, be it QE or in other parts of the world, even negative rates?
So the last 10 years were so far the height of the disinflationary forces that we faced. And really, it goes back before the global financial crisis, but really since the global financial crisis, we had very low inflation. In the United States, we had 3.5% unemployment for a couple of years, or right in that range for a couple of years, and inflation didn't react at all. So we had that gave us the ability to really lean into the maximum employment mandate, and we did that. And I think that was the right thing to do in that world. That world seems to be gone now, at least for the time being. And we're living with, as I mentioned at the beginning, we're living with different forces now, and have to think about monetary policy in a very different way. So I think if you want to know the lessons to be learned of the last 10 years, look at our framework. Those were all based on a low inflation, environment that we had, and now we're in this new world where it's quite different, with higher inflation and many supply shocks and strong inflationary forces around the world. It's quite a different environment.
President Lagarde, how do you think we'll look at negative rates, first of all?
Well, I look at it in a similar way to Jay, and I think the last 10 years have been 10 years of heroic fight against disinflationary forces, with central banks demonstrating great agility to innovate and find sometimes alternative, accommodative ways of dealing with forces that have nothing to do with what we are experiencing now. So we're certainly learning from that period, but we are in a new in a new environment, which also, I think, will force us to show agility and capacity to respond fast to data that we are receiving at an accelerated pace and with a scene that is changing geopolitically as well as economically.
Mr. Carstens, do you think...
But I don't want to sound too dark, because I think that there are also good things happening. You know, I was reflecting on your comments, Jay, and, you know, think back, December 20, when we thought that this pandemic was going to hit us for the next 2 years, at least, until such time when vaccination would come to market. And vaccination came about in a matter of, 9 months, as opposed to the 3 years that it normally takes. In the same way, everybody expected a couple of weeks ago that the Geneva Agreement of WTO would be a complete illusion, would never happen. Well, certain things happen when there is goodwill, agility, creativity. So I have great faith in human inventivity and talent, particularly when it includes women.
To your point, though, a lot of these problems are happening because the recovery and the expansion have been so much stronger than and faster than expected. If you look in the U.S. labor market as an example now, it's a very good time to be in the labor market. You can, there are 2 job openings effectively for every unemployed person. So people are switching jobs, they're getting pay increases. It's a terrific labor market. The problem is that wages are moving up in some areas at levels that are not consistent over time with 2% inflation. So it's kind of overheated. Nonetheless, it's a byproduct of a very strong recovery.
Governor Bay, on pay increases, I mean, the UK is going through a bit of a bumpy ride with a lot of pay increases. How do you see that developing?
Well, of course, it's a reflection of the inflation world we're in at the moment. I mean, I'm on record as having said a few months ago that, and I'll be careful because I'll get it right and precise in terms of what I said, that I think very high pay increases, and particularly. And this applies to both pay increases and price setting by companies. If everybody tries to beat the inflation, and particularly the version we're having, which is this imported inflation shock, which we just we can't avoid, then it will set the second round effects off. And of course, yes, we are seeing some of that tension unfold. I would have to note that rather more people seem to be agreeing with me today than were doing several months ago. But that's not the point. I mean, the point is, yes, I think it was likely that we would see this, but I think I have to say the point about second round effects holds as much today as it did then. I mean, that's the risk. And that's why we will set monetary policy, obviously, to offset those if they emerge to get back to target. We will have to do that. And that's, I'm afraid, the thin code for saying the more they emerge, the higher rates will have to be.
But what sort of pay rises could be alarming for the Bank of England? Is anything above 2% inflationary? Well,
I don't think that's the right way to look at it, because obviously there's always a productivity angle to it in terms of how pay is set. And it's very important that, I made a general comment about second round effects, but of course pay is set in a market, and that's important, and it must continue to be set in a market. So it's wrong to say across the economy this is the right number, because it isn't. Different cases and different situations. But I would just emphasize this point about second round effects, which is the crucial point for monetary policy.
Mr. Carstens, has there been an over-reliance actually on monetary policy in the last 10 years?
Well, I mean, I think even going a little bit further away, 2007, 2008, monetary policy needed to respond, to put it in a different way, lack of resilience in growth. And yes, to some extent, policies that traditionally are meant to support some fluctuations in the business cycle have probably been used a little bit more with probably in a more lasting way. And my sense is the role of fiscal and monetary policy to stabilize the business cycle into the future are hitting limits. In fiscal policy is obvious because there are issues of debt sustainability, or can be issues of debt sustainability. And well, now if we We had a long period where monetary policy could have an impact on growth because, as Christine said, as Jay Powell and Andrew have said, we faced a very, I would say, specific period of time of very low inflation, and where monetary policy could make, if you had the instrument, why not use it, no? But I think what we should learn, and this is not only, I mean, at the end of the day, the economies do not depend only on monetary policy. At the end of the day, they depend on fiscal, monetary, but also many other real policies that are out there. And what we have seen is in the last 10, 20 years, it's a very unreliable process of economic growth in the world. Some, of course, have been distorted by issues like wars or pandemics, but even before, I mean, we don't have the resiliency in growth that we would like to see. And that puts at different points in time a lot of stress on fiscal and monetary policy. And at some point that has some impact. So I think, yes, monetary policy will have to adjust, will have to evolve. We are learning lessons. But I think where we need to work more is to understand growth and how can we promote it in a more reliable fashion.
Who doesn't agree with that on the panel? Does everybody?
It depends what kind of growth. And I really think that the determination of the Europeans to focus and encourage investment in the green growth is critically important. If we want to develop the economic potential of any economy, you have to go in that direction.
That's the part of reliability.
Yeah. And resilience.
Yeah.
If you don't. Yeah. Okay.
Governor Bailey and then Chair Powell.
Well, I was going to observe, I mean, a point I was going to come into on following what Jay and Christine were saying earlier about what we've learned from the last 10 years, and then make a point on growth. I mean, one of the things we learned over that period was that the sort of the underlying interest rate, the sort of structural R-star, seems to have gone down for a long period of time, actually, certainly in the UK when we look at it. The question is, what do we learn? You know, these structural issues that we're facing today, what do they imply for it? I'm probably not in the same place as Charles Goodall, because I think these trends are so long run, particularly on the sort of population side, on longevity side, that they have quite a long way to play out, even on the basis of what we know today. So I think the underlying story will obviously move, but there's a lot that's sort of built into it already. Just on the shorter run point on growth, I mean, I think one of the puzzles which we're certainly looking at on that, though, if you take that sort of underlying story of the last decade, certainly in the UK economy, is why hasn't investment been greater? Because there's a gap opened up between the sort of the risk-free rate and the return earned in the risk-taking environment, and yet investment has been very subdued. Now, I think the other question we have to ask there, but are we capturing investment there? I mean, it's something we're looking at certainly, which is there just more investment of a non-traditional sort, which probably not wholly, but in part helps to explain that. But I think, I see that as an important issue to understand in terms of what we want to know going forwards, because there's no question that investment is, Christine was saying, in terms of climate change, it is a big part of the picture going forward, and how we solve some of these issues that we've been living with in terms of low investment and low productivity in our case as well.
Chair Powell, do you think we've been over-reliant, actually, on monetary policy, especially as the Fed?
Yes, I do. And I would just say, I think that in economic discussion generally, there's much too much focus on demand management and not enough on things that will make us grow at the maximum sustainable level, sustainable growth in the longer run. There's not enough focus on that. And that isn't the Fed's job. That's more the job of, again, elected governments. But I'd like to see more of that.
So how should governments be thinking about their economic policy going forward if monetary policy is not the only game in town?
You're asking me that?
Yeah.
So I'm kind of out of the business of giving advice to the fiscal authorities these days. So I would just say, I think when I get asked that by an elected representative, what I say is focus on investing in people and investing in things that will increase the productive capacity of the economy over time. That's what I say. And in terms of, I think what a central bank should do is stick to its knitting and do its job and leave the major issues of the day to the elected representatives.
President Lagarde?
We have to stick to our knitting, that's for sure. But if we are asked for advice, we should give it. And I think that, to the extent that fiscal and monetaries have worked hand in hand during the pandemic and to good effect, I think we should also reflect on how fiscal can leverage what we do and how we can facilitate it. But this is no longer the same cooperation, hand-in-hand work that we used to do during the pandemic. And I would give the same advice. Invest in people, invest in green, be targeted and focused. And in the medium term, the fiscal space has to be made sustainable for all countries, certainly in the euro area.
Yeah, Mr. Carstens, what's the correct way of fiscal policy to help monetary?
Well, I would definitely add my voice to invest in people, but I would say more in different aspects that enhance the human capabilities. Very specific. Well, education is one. I think what we have learned with the pandemic is that health systems are extremely important, and I think to a large extent we have invested there. The other thing is that all digitation will imply, and technological advance will really impose very, very dramatic pressures in many countries. And I think to how to adapt ourselves to that is very important. Climate change, as Christine said, is of the essence. In many parts of the world, incorporating ladies, females into the labor force is very important, and investing more in them, I think it's also of the essence. In many parts of the world, law and order is very important.
Yeah.
And so I mean, there is the good and bad things is that there is a lot to be done, but there is a wide variety of areas where we can act, and I think it can make a difference relatively soon.
Governor Bailey?
Well, I mean, Jay's right. Independence goes both ways in our world, and we must respect that, and we do. I think there's a common interest, going back to what I was saying a few minutes ago, in understanding why the trend rate of growth has fallen, because it has, in our case, it has fallen. Now, I don't then, for a central bank, I'm not going to start prescribing what should be done about it, because I think in most cases that will be outside our remit. But obviously, we have a strong interest in the trend rate of growth. So understanding the trend rate of growth is an important thing, and it's something where we can collaborate in that sense, I think, perfectly happily.
It's 3:27, so we only have 3 minutes. And I mean, I'd like to ask you, just to close us off, Chair Powell, if you're speaking now to the American people to try and help them understand how long it will take for monetary policy to go back to something that resembles normalcy, what would you tell them?
I would say that we fully understand and appreciate how the pain people are going through dealing with higher inflation, that we have the tools to address that and the resolve to use them, and that we are committed to and will succeed in getting inflation down to 2%. The process is highly likely to involve some pain, but the worst pain would be from failing to address this high inflation and allowing it to become persistent.
President Lagarde?
Ditto.
Governor Bailey?
Oh, absolutely. I would just add
You have more time.
one thing that is to Jay's point and Christine's point about understanding the pain. This form of inflation is even more painful for those on low incomes because it is concentrated in the essentials, in energy and food. And when you look at the consumption baskets of different groups of income groups of the population, sadly, it's those on the lowest income who are most concentrated in those things. And that is very difficult and something that obviously is very sad. But we have to do everything we can, because as Jay said, if we don't get it back to target, the consequences are worse.
Yeah. All right, it's 3:30 p.m., so thank you so much for joining us, and thank you so much for a great panel. I'm going to ask the gentleman to follow me, and Madame Lagarde, you stay on stage. Okay.
That was Bloomberg's Francine Lacqua moderating a panel with Fed Chair Jay Powell, ECB President Lagarde, Christine Lagarde, BOE Governor Andrew Bailey, and the Bank for International Settlements General Manager Augustin Carstens from Sintra, Portugal. It was a really wide-ranging hour-and-a-half interview. The markets moving during the hour and a half, it really felt like central bankers were sticking to their knitting, and you can see that evolving within the equity market. Flat on the day. We were a bit lower, but relatively flat. We are seeing some money come into the bond market and some money come into the dollar, as well as to commodities. You have yields moving lower, particularly on the back end. The overwhelming message really from all of them is that we will feel pain here as we bring down inflation, but it's going to be worth it, because if we de-anchor inflation expectations, that's going to be a lot worse. How we get there was a lot of vague conversation about that, and how the models are working also was really up for debate within this wide-ranging panel, Guy.
Yeah, and the relationship between the markets and central banks remains a confused one, was my takeaway from this. Certainly the markets feel like in some ways they are leading, but Fed Chair Jay Powell talking about the fact that that didn't feel like it from where he was sitting. In terms of the process of bringing demand down so that supply can catch up, that is basically what Powell was talking about. He believes that doesn't necessarily imply a recession. Nevertheless, you look at market pricing, and that certainly is pointing us in that direction. And you look at some of the recent data, which would seem to take us there. The question is, how deep will that recession be? Is it a shallow one? And if it is a shallow one, is that enough to push inflation out of the system? So a lot to think about, a lot coming out of that. The market's obviously hanging on every word from those central bankers. Let's pivot back to a little earlier on in the conversation that Francine had with them, and hear a little bit more about what the Fed Chair Jay Powell said a moment ago.
If what we see, for example, is the redivision of the world into competing geopolitical and economic camps and a reversal of globalization, that certainly sounds like lower productivity and lower growth. And in many parts of this side of that, you see aging demographics, so a shrinking workforce, and you see economies that are growing more slowly and whose workforces are not expanding. So that's certainly a possible outcome, and I think probably to some extent a likely outcome.
And in the shorter term, can the economy, can the U.S. economy actually deal with, a possible onslaught of interest rate hikes?
So the U.S. economy is actually in pretty strong shape. So if you look back a year, the U.S. economy grew more than 5.5%. It was really the big reopening year. Mm-hmm. And so we had expected this year to be that growth would moderate to a more sustainable path. We also, of course, are raising interest rates, and the aim of that is to slow growth down so that supply will have a chance to catch up. We hope that growth can still remain positive. But if you look at the strength of the economy, households are in very strong financial shape. They've still got a lot of excess savings from forced saving from not being able to travel and things like that, and also from fiscal transfers. So households are overall, not every household, and not the ones at the lower end of the income spectrum, but overall in strong shape. The same thing is true of businesses. Very, very low rates of default and things like that. Lots of cash on the balance sheet. The labor market is tremendously strong, still averaging very, very high job growth per month. So overall, the U.S. economy is well positioned to withstand tighter monetary policy, we think.
But is it automatically a trade-off between fighting inflation or taking care of the economy, and how far are you willing to go with interest rate hikes?
So I guess I'd say it this way. Our aim is to have growth moderate. It's sort of a necessary adjustment that needs to happen, so that, again, supply can catch up. It could be supply of workers. It could be time for the supply chains to improve. So the sense of that is that if we can get, right now, supply and demand are really out of balance in many parts of the U.S. economy, the labor market being a big example of that. We need to get them better in balance so that inflation can come down. And that's the aim of what we're doing. Now, we don't have precision tools. Obviously, monetary policy, famously a blunt tool. That is our aim, that is our intention. We think that there are pathways for us to achieve that, to achieve the path back to 2% inflation while still sustaining a strong labor market. We believe we can do that. That is our aim. Mm-hmm. There's no guarantee that we can do that. It's obviously something that's going to be quite challenging, and I would also say that the events of the last few months have made it significantly more challenging, thinking there particularly of the war in Ukraine, which has added tremendously to inflationary pressures around food and energy commodities and agricultural chemicals and industrial chemicals and things like that. So it's gotten harder. The pathways have gotten narrower. Nonetheless, that is our aim, and we believe that there are pathways to achieve that.
That was Fed Chair Jay Powell from the ECB Forum on Central Banking in Sintra, Portugal. Let's get more reaction now. I'm bringing in Michael McKee, Bloomberg International Economics and Policy Correspondent. Hey, Mike, it really seemed like all the central bankers there were doubling down, like we are going to inflict some kind of harm on the economy, but it's worth it because inflation expectations getting de-anchored will be the even bigger risk. Did you learn anything new?
Nothing really new in terms of anything that would affect the markets or any kind of change to what you think the monetary policy path will be. Perhaps the only new thing we heard was Christine Lagarde saying the new anti-fragmentation tool would be discussed at their next meeting on July 20th and 21st. First time she's put a time
I feel like she slipped
on that.
On that one a second.
But in terms of where they are, what they're all saying is uncertainty is key. We do not know what is going to happen to the overall economy because we've had a series of shocks we did not anticipate. And that touches on the fact that our models were wrong because we didn't anticipate the supply shocks that we got. So we have laid out a path now that we think will get us to a place where inflation comes down and eventually gets to 2%. Yep. But there's a lot that can happen between now and then. And so we might have to tighten more. We might have to go too far. There will be pain, but it's much worse if we let it go and let inflation get embedded in all of our economies.
Mike, the real question I think the markets are now trying to grapple with is, yes, you want to get inflation to target, but that's not something that's going to happen overnight. As you say, it's going to take quite some time to get there. Do we understand how long it's going to take to get there? And when the central bank is going to know, whichever central bank it is, that they are on the right track and have the right policy settings and stepping of that settings to get to that target?
Well, unfortunately, the answer to both questions, Guy, is really no. We don't know how long it's going to take, and the central bankers on that stage made the point because there have been a lot of unanticipated supply shocks. We could have something else happen with COVID. We could see the war drag on or some expansion of it. Those kind of things will delay bringing down inflation. But the problem for the central banks is they're all dealing with backward-looking numbers. And we saw during this panel, markets level off a little bit and bond yields fall, largely because first quarter GDP in the United States was revised down because of a big downward revision in consumer spending. Now, that was January, February, and March. And so if you're making policy today based on what you thought had happened then, you're way behind the curve. Maybe the economy is slowing more quickly. How does the Fed know that? They don't. And so that is part of the tricky aspect here for all these central banks going forward.
Which I think also then raises the question of their models. And they got the question of, can you adapt to policy quickly if inflation, like Paul Krugman was talking about, comes down faster than we think? Do they have the right models? Some of them up on the stage, like Andrew Bailey or Carstens, were a lot more introspective, it seemed, in sort of if their models work, what they got wrong versus, say, Jay Powell. Did you pick up on anything there?
Well, their positions have been pretty much that for a while. The Fed's position, Jay Powell's position, is that the models work given the inputs that they were given at the time because the models had been based on what had happened for the last 20, 30, 40 years. Unfortunately, everything changed in inflation dynamics as you got these additional supply shocks. And the supply shocks weren't accounted for because they were so large and so fast. And that's the problem for the central banks, is adapting to the possibility of something like that happening again. Now, can you adopt your models? That's a question because this was such an out-of-the-blue exogenous shock to the global economy.
Okay, so Mike, let's go from the models and let's focus here on the Fed. Model, dot plot, which is what gives us the clues as to where the individual members of the FOMC thinks things are going, to the financial markets. Powell talked about the fact that the markets and the dot plot fairly well aligned right now, and the markets are doing some of the heavy lifting for the central bank. But if the models are all over the place, that means in theory the dot plots are going to be all over the place, which they have been, which means that the market can expect significant volatility going forward from here.
Well, if we're just talking about the Fed, you basically have agreement in the dot plot for what's going to happen in 2022. Then as you go farther out into 23, 24, the dots get farther apart and uncertainty gets greater. And I think what the Fed has been happy about is that the markets have anticipated what the Fed was going to do, and the pricing now from the markets is about where the dot plot says it's going to be for the rest of this year. The Fed doesn't want to go farther because they aren't sure. They're just guessing this far out where the market is adjusting on a day-to-day basis. But right now, that raises the question of, is the monetary policy change getting into the economy faster, which gets back to that question of when does the Fed know what's going on? Does the Fed have to adjust more quickly? I was a little puzzled by Powell saying he didn't think the markets were leading them. They're not forcing the Fed to do what they want them to do, but they are anticipating where the Fed is going to be, and he admitted they've done a pretty good job of that.
Which maybe comes back to this whole idea that policy works with a lag, but maybe that lag in this kind of supercharged, super fast environment we're working in is a little less than maybe we all thought it was. Mike McKee, thank you very much indeed. Let's carry on with that element of this conversation. Ira Jersey, Chief US Rate Strategist at Bloomberg Intelligence, joining us now. Ira, what do you make of that whole point about the fact that actually the markets are anticipating and are already kind of where the dots ultimately ended up being? They got there much faster. And what do you think that means in terms of the impact that anticipated policy is going to have on the economy and the role that the market is playing within that?
Well, there's a lot to unpack there in that question, but I think number one is there's been a significant shift over the last 20 years, certainly since the global financial crisis, in the Feds and indeed, the ECB's and the Bank of England's communication policy. So the idea is that they want to basically have the market front run what they're going to do. They want to be as transparent as they can with still owning a little bit of optionality, like Lagarde had mentioned as well during that panel that we just heard. So I do think that they're happy that you see higher interest rates being priced for the future. Now, what's interesting though is that you have seen today during the speech that you did have seen the yield curve start to flatten just a little bit more, and part of that is in anticipation that central banks are going to continue to be hawkish, but the economy will slow in the future, and that's why you have very flat yield curves now. Why the yield curve in Europe has flattened quite significantly over the last couple of weeks, and the U.S. yield curve is likely to invert, just because at some point, even if we don't go into a technical recession, we will have to have a substantial growth slowdown in order to get inflation down to reasonable levels.
So, Ira, it really feels like the central banker's reaction function to that is to ignore it. I mean, you basically had Fed Chair Jay Powell's like, yeah, yield curve is part of our input, so is the dollar, but we don't really pay that much attention to it. What's going to happen when the markets kind of front run that and they start pricing in, say, rate cuts in 2024 because of the risk of recession?
Well, we're actually already pricing for that now. And in fact, if you look at the dot plot shows that too, right? The Federal Reserve thinks that that in general, you'll have a peak interest rates next year. They'll start to cut a little bit in 2024. And then the neutral rate is somewhere around 2.5%. So they go up to 3.5 and then they come back down to 2.5 over time. I think that for the Fed, the market has to be a little bit of a signaling tool. But right now, and I think Jay Powell, it was very clear a couple of weeks ago, he reiterated this today, the economy in the U.S. and particularly the labor market is very strong. So the point that we've been trying to make is the Fed right now only has a single mandate. Normally it has two: full employment and stable prices. Now it can just focus on that price mandate because the labor market is so strong. Mary Daly yesterday on an online stream mentioned too, like, look, unemployment going up a couple of tenths is something that we expect to happen, and we kind of need to happen because we need to get demand a little bit lower and we need to get inflation down. And that has to be our priority right now because it's the bigger problem than the labor market at the moment.
Ira, when will we know if the market believes that a recession will be enough to get inflation out of the system?
Yeah, we might not know that till next year. In fact, I was just, our team was just looking at what the market is pricing for inflation at year end. And we are still expecting, the market is still expecting year-on-year inflation to be over 7% in December of this year. So not coming down as quickly as a lot of forecasts suggest in the economics landscape. So really, we might not know until, next year sometime how effective a lot of this monetary policy is. And any central banker will tell you there's long and variable lags. Mike McKee was just mentioning that maybe those lags are a little bit shorter. I'm not sure that they are. I still think that it will take a substantial period of time for some of these policies to filter through the economy, in part because of some other things that were mentioned on the panel. You still have household and business balance sheets that are very strong. You have excess savings built up that can be used to make purchases for some period of time, but eventually that ends. And it's really unclear how quickly all of that excess savings is going to be spent. And as long as it's still in the system, you could still have inflation that's a little bit higher than the Fed's comfort level.
Ira, what's your level of confidence in central bankers and their models? There was a lot of conversation about that. Yes, markets as well, but also just in their models and kind of where they went wrong. And I ask that because if they don't really know where they went wrong, they're not going to really know then how to get it right and how to adjust policy in the same way and as flexible if inflation does wind up coming down quickly, if we do hit some kind of recession. What's your level and the market's level of confidence?
Well, I have a lot of models for a lot of different things. And, we all take them all with a little bit of a grain of salt because it's all garbage in, garbage out. So you can't predict everything, right? So every single model that we have, we know that there are things that shift in paradigms. We know that there are things that you just can't forecast, right? We can't forecast a war. We can't forecast, supply chain issues at the Port of Los Angeles, right? Those are all things that are exogenous to these models and you have to be aware of. But you can't forecast them, right? You can't forecast an exogenous shock. And that's always the challenge ex post because you need to react to those exogenous shocks in some way that maybe you're not sure what the sensitivity of your policy is going to be to the resolution of those shocks. And I think that's one of the points that central banks are trying to make is that they thought that all these supply shocks were going to go away. They didn't. Now they've led to demand shocks. And now that means that inflation, at least priced by the market, is going to be more persistent than they hoped.
Hey, Ira, such great analysis as always. Thank you so very much. Ira Jersey of Bloomberg Intelligence. Thank you for joining us dissecting that mega panel that we've had there. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta. You're looking at a live shot of the principal room. Coming up, Richard Haas, Council on Foreign Relations President, joining Bloomberg Television, 12:30 p.m. New York time. This is Bloomberg. Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Turkey's President Recep Tayyip Erdogan will meet with President Biden to push for the purchase of new F-16 warplanes. The two will talk during the NATO summit in Madrid. Erdogan is now seeking to capitalize on a relatively positive atmosphere in relations with NATO and the US. Ties had grown cold after Turkey bought advanced Russian air defense systems. The wife of Supreme Court Justice Clarence Thomas has declined the January 6th committee's request for her to testify. A lawyer for Virginia Thomas says there is no sufficient basis for her to appear before the panel. Emails have indicated that her efforts to prevent Joe Biden from taking office were more extensive than previously known. And the pressure is building more on a European Central Bank to raise interest rates for the first time in more than a decade. Inflation over in Spain has unexpectedly soared to a record 10%. That beat all estimates in a Bloomberg survey, and it dashed hopes that inflation in Spain had peaked. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Struggling home goods retailer Bed Bath & Beyond has replaced its CEO. Mark Tritton is leaving more than 2 years after arriving from Target. Board member Sue Gove will be the interim CEO. The move was made moments before Bed Bath & Beyond released another lackluster earnings report. As of yesterday's close, shares were down some 55% for the year. And consumer spending in the US expanded in the first quarter at the softest pace of the pandemic recovery. Spending on goods and services rose an annualized 1.8%, compared with a 3.1% pace in the last estimate. That suggests the economy was on a weaker footing than previously thought. And Bloomberg's learned that troubled crypto hedge fund Three Arrows Capital was ordered into liquidation by a court in the British Virgin Islands. This week, crypto broker Voyager Digital issued a notice of default to Three Arrows after failing to get repayment on a $675 million loan. A consulting firm plans asset sales, including Three Arrows holdings in crypto startups. And that is your latest business flash, Alex.
Thanks so much, Ritika. And I think that, Guy, this goes to sort of the heart of the issue when it comes to crypto, is the contagion effect. Like, we all know that there's not enough space for all of these guys to exist in the crypto world, but it's who lent to whom, who's going to get repaid, and then how that affects their business models and the systemic risk, if there is any, that we need to be paying attention to.
This is the thing that we don't know around this slowdown. What is systemic and what is not? Now, clearly, coming out of the GFC, we've tidied up a lot of the issues around what is systemic around the banking sector, the traditional financial sector, but it's moved elsewhere. And clearly, crypto is going to be one area that I think central banks, regulators are going to have to pay a great deal of attention to. What is going to be the systemic effect here? We've obviously seen, huge moves lower already in terms of asset prices. But do we fully understand yet the implications of that? The lines that are connecting some of these financial elements of the system, still unclear to my mind at this point.
Yeah, and also I think the question then becomes, how correlated are these assets going to be to the rest of the market? So as rates rise, do more than get shaken out? We don't know that correlation yet necessarily either.
I think we've got some idea of it. Clearly, they are more correlated than we first thought. I think that probably is maybe true. We'll talk more about this, obviously, as we work our way through the rest of today's session and continue to see maybe some of those effects showing up. Up next, we're going to be talking to Ted Christie, Spirit Airlines President and CEO. Big day coming up for that airline. The close is next. This is Bloomberg.